taxation. He also has treatises and was a speaker in several events regarding in the past to the U.S. tax reform, and we are happy to have here with KPMG sharing his views regarding what is coming in terms of tax reform. And was a speaker in several events regarding in the past to the U.S. tax reform. So, Professor Wells, the panel is all of yours to start.
All right, so then I will, there are some logistical questions. Do we want to go through that before I start the presentation?
Sí, buenas noches con todos. Antes de iniciar este seminario, les informamos que tienen todos habilitados una opción para que puedan seleccionar el idioma de preferencia en el que quieran escuchar el seminario. Si seleccionan la bolita de mundo que dice Interpretation, pueden escuchar en inglés la exposición del profesor o en español, según prefieran. Gracias. Ahora le doy paso al profesor para que pueda proyectar la presentación.
Creo también que es importante señalar que se pueden hacer preguntas. Las vamos a tratar de ir contestando durante la sesión o al final de ella. Entiendo que para eso está habilitado la función del chat o del Q&A en la pantalla. Por lo tanto, quienes se animen a hacer las preguntas y establecer la conversación, muy bienvenidos. Sabemos que la mayoría de los escuchas hablan en español, así que no sientan problemas en preguntar en inglés o en español. Aquí van a ser bien recibidas y dirigidas al profesor y al resto del panel.
All right, well, it's a pleasure to be with all of you this evening to talk about some changes with the OECD and the international tax community and the things that are evolving in that area. So we're going to have a conversation that is unusual. Most of the time we think about tax law changes from each particular country. And each country, through its legislation, will adopt rules. We are in a unique environment where the countries are agreeing to a multilateral approach, and there are many open questions about this multilateral approach. So what I hope for us to think through in this session is the change in tax law that is being proposed, and for you and KPMG's clients to think about together what these changes can mean or may mean to your businesses. Now, on the slide that you should see in front of you, I have a timeline that sets forth a very aggressive timetable for implementing what are some significant changes in the international tax system. In June of this year, there was an announcement of what the OECD claims is an inclusive framework. Now, there are some countries that had more inclusiveness than others. So we need to think through who was really part of the framework and who was not as much part of the framework. More on that in a moment. But that was announced in June of this year. In July of this year, the G7 and the G20 and the European Union all endorsed the OECD inclusive framework. And they commissioned the OECD to come up with further reports that are going to be issued in October. In October, there will be a final framework, and we have some understanding about what that framework will look like, and the rest of this presentation will talk through that. But then there will also be a final endorsement on that date. In the end of this calendar year, at the end of this calendar year, there will be treaty provisions that will be required, and those will be implemented next year. That's what the countries have agreed to, that within 1 year of this upcoming fall, there will be changes to both the domestic legislation and the tax treaties of all countries that adopt this framework. And then by the end of 2023, implementation will have been finished. So what the OECD has signaled is that there will be reports issued in October, countries will adopt in 1 year, and then finally in 2023, all of these new rules will come into place. Now, the OECD's work has been endorsed by 130 countries plus 2 additional countries. So 132 countries have agreed to adopt the inclusive framework. Now, there is a question in terms of what the countries understood that they've agreed to. But what I want you to understand is that 132 countries have agreed that they will do what the OECD has outlined. That is amazing. If you get nothing else from this presentation, you should understand that what is being proposed is a fast, rapid change in the way international taxation will be done in Latin America and throughout the world. Whether or not this happens is a good question, but you should be prepared for some significant changes. All of these changes are being done before the local legislation is drafted. Think of that. Now,
Professor?
Yes.
Yeah, just to enter into each of this topic, I would like to understand, and for the rest of us, the general context in which this international effort is taking place, which is behind this, besides the new rules and the new system that are intended to be done, which is the economics or the rationale behind this new system that is going to be in place?
There are several different points of view. One point of view is that the OECD and countries in combination want to stop the ability for income to escape taxation, to deal with tax havens and low taxed income. That's one point of view. Another point of view is that the developed nations did not want countries in developing nations to develop their own unique solutions. They wanted to have a unified approach where developing countries would not do things that were unique to the local environment. And so, depending on what point of view you want to take, there's an effort to prevent low taxing rights of multinationals, but also to prevent developing countries from having unique tax solutions. And as we go through this framework, you're going to see both truths being evident, that there is an agreement that countries will only use the methods of taxation that the OECD has outlined. So there's a unity or coordinated approach, but it will also prevent low taxed earnings. That is at least two different points of view.
Okay, thank you.
So
and what about the digital economy on that area as well? It's something important, I think.
yes, the digital economy has been the catalyst, or a large catalyst, for this conversation. So in what the inclusive framework calls Pillar 1, is it sets forth a taxing right for countries to tax digital commerce without any permanent establishment. So if a country, if a company, a multinational, is engaged in systemic business activity, then the inclusive framework will allow 20 to 30% of the residual profits earned through internet sales, digital electronic commerce, to be taxed in the market economy. So the idea that I can avoid a permanent establishment and not have a physical presence and therefore not be taxed in the local economy, no. Going forward, the market destination country will have a right to tax 20 to 30% of the residual profits. That is still to be discussed. Now notice, you see the tension. You do not need a permanent establishment to be taxed. The market country will be able to tax some of the profits from their country for importing goods or services into the country, but capped at 20 to 30%. So multinationals are going to pay some additional tax for selling into a local marketplace, but not 100%. So the compromise is that if someone is selling, think of Amazon or Facebook or Apple, I sell things into an economy from a website, and I have no physical presence. Even though I don't have a permanent establishment, Pillar 1 will allow countries to adopt mechanisms to tax 20 to 30% of the residual profits, but that's the extent. The remaining profits are called Amount B. Amount B is all of the routine profits, and the other 70% of residual profits would be subject to normal transfer pricing rules and normal permanent establishment rules. So Pillar 1 is giving countries an additional taxing right to tax those participants that are selling into the local economy without a physical presence. But it's limited. It's not the full extent of the profits, it is limited. Now, in order to implement this taxing right, to tax the so-called Amount A, there will be changes to the permanent establishment provisions of all treaties. And there will be a dispute resolution process to determine what is the amount of profits that are eligible to be taxed under this particular regime. Now, the companies that are considered in scope that are going to be subject to this regime are only companies that have global turnover in excess of 20 billion euros. If someone's profitability to revenue is greater than 10%, then the revenues of the global company is 10 billion in euros, 10 billion euros or more. So in the first instance, this taxing right will only apply to the largest multinationals. But the OECD has indicated that after 5 to 7 years, this threshold would be reduced so that more multinationals would be subject to this special regime. So the idea is that market economies will have the right to tax the largest multinationals. There will be a period of time when only the largest multinationals are subject to this tax, but then the threshold will be reduced to allow other multinationals to also be taxed. There is a nexus statement.
Sorry, Professor. Sorry,
Yes,
Professor, for interruption. In the point one, and you put the point in which you are pointing out the exceptions of this rule, that is extractive industries and the financial services industry. And this,
yes.
And this definition of financial services industries have generated a lot of concerns or in relation to the scope of this definition, because what is not clear from the papers provided by the OECD is if the financial service industries are only those that are regulated by the financial authorities and has specific regulations to comply with, or it can be possible to consider probably other different activities as a financial services. We can put an example of treasuries of big companies, for example, that they are carry out financial services unregulated, or inclusive. We can call the credit card issuers, the regular brands, are not financial services itself. They are part of the change of credits, but seems to be that it's not very clear if they are, they fall in the financial services or not. I don't know if you can give us probably an element here in order to define what would be the scope of this concept of financial services.
Yes, so if there's any clients on this call that are financial services entities that are not banks, they should ask KPMG to speak for them at the OECD. I mean, that should be a conversation right now, because it's clear that banks will be part of the exception. It's also clear that there will be more clarity on who is a financial services industry in the October release. But if you're not a bank that's subject to banking regulation in your country, there is a very real possibility that you will not meet this exclusion. The question of what companies are in the extractive industries. If someone owns a mine or they are operating oil and gas activities, they're the national oil company, they will not be subject to these rules. I think that's the case. But think about the many service companies and other companies that are in the oil and gas or mining business that do not own the natural resource. Are they accepted from these rules? Right now, that is an open question. We will find out more in October, but at least the things that have been written so far is that if you're not a bank regulated as a bank in your country, or you're not the national oil company, you should speak with KPMG almost immediately. And you should think about what are the scope of these exceptions, because that is a large ambiguity today. It's a large ambiguity.
And before going to the next subject, talking about extractive industries, one thing for us, maybe it's more clear the case of oil and gas and mining industries, but what about other extractive industries? What is the scope? And also, as you mentioned, of course, the extractive industry have a physical presence in a country. So as you say, the impact could come from providers that perhaps if they are affected, it could transfer the cost to these companies that have physical presence when these rules apply.
Right.
What about that?
So there needs to be a coordination between being subject to the extra tax by the market jurisdiction and getting credit. So if someone is subject to this extra tax, then there is going to be a provision to eliminate double taxation by giving a foreign tax credit or some other concession to the companies that have borne a tax in the market jurisdiction. So that is a process that still needs to be ironed out. But in concept, if someone is subject to tax because they've sold into a jurisdiction without having a permanent establishment, but are subject to tax in that other jurisdiction, then their home country should give a foreign tax credit for the market tax that is collected by the other jurisdiction.
Thank you.
Now, how do we determine profitability? That will be done using financial statements, IFRS, International Financial Reporting Systems, or statements prepared according to generally accepted accounting principles. Now, I do not need, the people on this call should very quickly understand. A company may have its financial statements in euros or US dollars, but there may be a significant difference in terms of the profit and loss in terms of the local currency. And so how we apply the tax rules to collect this tax when the profit thresholds and the amount of profit to be allocated is determined by financial statements, and it sets the threshold of how much profit can be taxed in the other jurisdiction, but the tax rules are going to apply in terms of sales into the country and local currency. And so the interaction of financial statement records and your local sales and local currency is an ambiguity that remains to be worked through in this process. And I don't think that's going to be a simple process to work through. Now, the projected path is that these questions and many more will be finalized through legislation by the end of next year. And let me say it again, 132 countries have said, we will do this. Without the local legislature having draft legislation in place yet. So this is a significant lift. This is a very accelerated timeline. Now, why did the OECD want to put this in place and require companies to adopt an approach for the maximum amount of profits that a market country could tax, and then have a framework and modify the treaties to allow for this right, but to ring fence this right to only a particular amount of profits? Well, it's because many countries were starting to implement digital taxes to tax the profits for selling into their jurisdiction. And each of these jurisdictions has a unique digital tax. The OECD is requiring, when these countries agree to this framework, they will eliminate their existing digital taxes and conform their taxation to the OECD guidelines that will be finalized in October. So now we see one of the benefits that the multinational corporations potentially get from this agreement. The benefit is that these unique tax regimes must be repealed, and there will be a consistent approach that will be adopted by all countries. Now, for countries that are very nationalistic, the idea that the OECD or the developed nations, the G7, would tell other countries what their legislation is going to look like, and that it can only look like these things, is a offensive thing. And so there's going to be some conversation about national policy and whether or not this effort is stepping on the sovereign rights of developed nations to be able to implement their own rules. But
Professor, excuse me, one question there, because this is very interesting, because what you're saying is that this new tax will replace the digital service tax, correct?
Correct.
But what would be very challenging is this issue of the double taxation procedures, because actually, I don't know if it is expected any interaction between the existing taxes on cross-border digital services and this new tax. For example, in LATAM, you know that LATAM imposes very high withholding taxes on cross-border digital services and also VAT on digital services, even provincial taxes, turnover tax. So is there any expectation of any reconciliation between all these existing taxes that are being applicable and this new tax? Because actually, I think that otherwise we will be facing a double taxation issue.
Yeah, that's a great question. So the VAT will not be affected. The VAT, whether it's import VAT or the VAT that's paid in the local country, will be collected in any event. What the OECD is referring to as a digital tax is the tax on the income profits by selling into the country. Now, those digital taxes may be a % of gross revenue or the rest, but VAT will be unchanged. Withholding taxes will be unchanged. But if someone sells in the local economy, then there will be an extra tax for the offshore company that can be levied for their internet sales. And here's the thought process for it. If a local company had a physical presence, they would pay VAT plus income tax on their profits. But because this company is not physically present, there will be import VAT, but historically no income tax. Now there is an additional tax, the income tax, that can be collected based upon the sales into the country. It will be a formulaic tax. And the other jurisdiction must give a credit against the income tax in the home country for imposition of this digital income tax. And you're right, the coordination of the amount of that credit against the income tax of the offshore jurisdiction will be complicated.
Interesting, because actually it may take many multinationals to maybe evaluate a change in their business scheme. For example, moving local into a reseller structure instead of maybe operating from offshore. So
it's an excellent idea, because the OECD believes that if you paid a significant local tax already, you're not subject to this tax. But you may have an onshore company that has 30% of the residual profits and will not be subject to this tax. Now, how do we determine the profits of the multinational that are in the local company already that have been taxed, and how do we give credit to the offshore company is a complexity that will need to be worked out by the framework. But it's an excellent point that if you're going to be taxed already, it may well be better to have a local subsidiary that's already has a taxpayer identification number and will comply with this regime instead of having the offshore company subject to this additional tax. So the point that you should be thinking is that if the OECD's framework goes through and 132 countries have already said, we will adopt this, then it has a major implication to the permanent establishment transfer pricing thinking of how you do business in countries around the region. And it will require some fundamental rethinking. Now, that is pillar one. Pillar one is an additive right. It is saying to countries that even though you do not have a company physically present, if this company is doing significant business over the internet, virtually, selling into the country, then the countries will have an additional taxing right, and that additional taxing right will be up to 30% of the profits from that country, but no more. The remaining profits are subject to the normal permanent establishment transfer pricing rules. So it's an additive right. The countries get an additional right. They are not giving up anything other than the right to have a digital tax that could have done more. Pillar two, the second part of the inclusive framework, is dealing with a different problem. And pillar two does not require a country to adopt this pillar. A country can choose not to adopt pillar two. But if they want to do the things that are outlined in pillar two, they must adopt pillar two. So it's what pillar two we were going to discuss says that if a country wants to adopt taxing provisions described in this area, it must adopt provisions like the ones authorized in this OECD framework. But if the country does not want to adopt these provisions, they're not required to do so. They're not required to do so. Now, there are three key concepts that we need to understand for pillar two. There is an income inclusion rule. There is an undertaxed payment rule. And there is a subject to tax rule. And I want to define all three of those concepts, and then we will work through what the OECD is setting forth as their framework. The income inclusion rule is a rule that says that if a multinational company is headquartered in Brazil, in Chile, in Mexico, some jurisdiction, then the ultimate parent company has the right to tax all of the profits of any foreign affiliate if it chooses to do so. It can choose to tax the income of its own company and any foreign affiliate owned by the parent entity. If they have such a rule, that is an income inclusion rule, it must be done according to the process and the protocol that the OECD has announced. Now, there's a subject to tax rule. The subject to tax rule is a rule that says that countries can condition the reduced withholding taxes under the treaties. A country gives a lower withholding rate on interest or rents or royalties. They can give a concessionary less reduced rate, but make it conditional on the recipient jurisdiction subjecting the payment to a minimum tax. So what the OECD envisions is that you may have interest paid from one jurisdiction to another that may be subject to 0% withholding or 5% withholding. But if the recipient jurisdiction does not subject that payment to a minimum tax, of 7.5% to 9% to be determined. It's not subject to a minimum tax in the recipient jurisdiction, then the withholding rate concession disappears. I can say it another way. The idea is that you get concessionary withholding rates to reduce the withholding on payments out of the country only if the other jurisdiction subjects the payment to a minimum tax. It's a conditional provision, and the treaties will be modified to allow this subject to tax rule. Now, the final leg is what is called an undertaxed payment rule. The undertaxed payment rule says that you can allow a deductible payment to be made to the other jurisdiction as long as the income of the recipient jurisdiction is subject to a minimum tax. But if the deductible payment is made from a jurisdiction to another jurisdiction and the other jurisdiction does not subject it to a minimum tax, then the deduction is denied. In concept, the undertaxed payment rule and the subject to tax rule are similar. The undertaxed payment rule is dealing with, I'm conditioning the deduction benefit on the other jurisdiction subjecting the income to a minimum tax. The subject to tax rule is conditioning the lower withholding rate on the other jurisdiction subjecting the concession income to a minimum tax. Now, notice the difficulty for the tax advisor. Someone asks you, do I get the local deduction for making this payment of salary, of interest? Do I get the withholding rate? That is a lower rate. Now the question is not just whether or not these are deductible in my country. I have to know the tax implications in the other country to know whether or not there is withholding or a tax deduction in my country. Do you see how the local advisor is going to have to know quite a bit about how the payment is treated over there in order to answer the question, am I entitled to a reduced withholding rate? Am I entitled to a local deduction? That is going to require much more coordination between the country of payment and the recipient jurisdiction. What is going to be required to prove that a minimum tax was paid? Oh, isn't that a wonderful question? I need to know that a minimum tax is paid. How do I prove that? Is it just a letter? Is it the tax return? Is it actual proof of tax? How do we prove that? Think about the compliance and documentation requirements to show that the tax paid in the other country came from my payment. That is going to require a significant complexity. It's a significant complexity. Now, the companies that are in scope for these rules are much more in scope. Do you see that the companies or any companies that have 750 million euros or more? Remember we said 20 billion euros for Pillar 1, right? Subject to a phase-in. The Pillar 2 is extending to many, many more companies that are potentially going to be subject to these rules. Now, how do I determine a minimum tax has been paid? Well, the OECD says that we will determine whether the minimum tax was paid by looking to the financial accounting statements prepared in euros or dollars, not local currency, to determine whether or not a minimum tax was paid. What is the minimum tax? Well, for the under-tax payment rule, the minimum tax that needs to be paid is 15%. Now, the US is negotiating to attempt to have that rate increased to 20 or 28%. But other jurisdictions are negotiating to have it 15% or lower. This is an ongoing debate about what's the minimum tax.
Yeah, Professor, if you allow me, as you know, these negotiations have been, let's say, somehow portrayed as a dispute between US, which is the home jurisdiction of the big tax, versus Europe or versus the market jurisdictions. And precisely as you pointed out in this slide, you know, the statement provides that the rate should be at least 15%. So I was just wondering, and you just mentioned what would be the position from the US. Can you just elaborate on that? You know, what is in terms of fiscal policy, why the US is looking for a different rate, and what is the rationale of such fiscal policy from a US?
Because the US wants to use a high rate. We want to tax at a higher rate. And in my further slides, I will show you that the Biden administration wants a 28% rate for US companies, and the Senate in the United States is considering a 25% rate. So the US would like the minimum tax for all other countries to be close to the US rate, so that US companies are not at a competitive disadvantage, or not much of a competitive disadvantage. They would like German companies and others to have this globe adopted, and for them to be subject to a minimum tax of 20, 25%. Why? Because US companies are going to be subject to a higher rate. Countries must have, if they have Pillar 2 adopted, and many of the European countries have said they would adopt this, at least the G7. And the question is the minimum rate 15, 20, or 25? The US wants to adopt a 25, well above the minimum, but we would like everyone else to have a rate not much lower than us, right? So there's a concern that if the US subjects their companies to a high rate, that could be a competitive disadvantage unless everyone agrees to a rate that's close to the US 25 or 20% rate. At the present time, the inclusive framework has said that countries have agreed that the minimum rate would be no less than 15%. But Secretary Yellen and others are lobbying hard for the OECD and other countries to have this rate higher than 15. That is an ongoing discussion. It's an ongoing discussion.
Professor, one question. What are the type of taxes that are going to be considered for the calculation? Are only going to be income taxes, or other taxes can be included, like equity tax and municipal tax over turnover, etc.?
That's a great question. It will only be income taxes. Now, what about asset taxes? Asset taxes in many parts of Latin America are are viewed as a minimum tax to ensure that income taxes are paid. The US view is that an asset tax is not an income tax. So if you pay an asset tax, you've paid zero income tax. But in the treaties with many other nations, many countries, Chile, Colombia, Venezuela, have gotten other countries to give credit for asset taxes against the income tax of the other jurisdiction. So this is an open question that is not resolved in the OECD framework. The US view is that asset taxes are not an income tax. Payment of an asset tax is not a minimum income tax. But other countries have taken a different treatment for asset taxes. And it would be very helpful for Latin American countries to get a concession from the OECD to say that if a company is subject to asset taxes and not income taxes, but they paid a minimum tax, that they should be given credit for that. Now, what happens with tax loss carryforwards? How is this going to be handled? Well, the OECD has said that there should be credit for tax loss carryforwards, and the use of a tax loss from an earlier year does not cause the minimum tax to not have been paid. You will get credit for that. But the US at present does not give credit for tax loss carryforwards for its taxes. So there is an ambiguity about how tax loss carryforwards will be treated. But think about if you have devaluation and in local currency, you have an exchange loss that creates a lower income tax for local tax purposes. You may well have a 30% tax in the country, but because of exchange valuation that doesn't get reflected on the financial statements, you would have a non-tax payment. So as you think through that, I'm looking at financial statement income and no tax payment, the question of how to handle timing differences or permanent differences is going to be a significant issue. You could have a country that has a marginal tax rate of 20, 30%, but fail this minimum tax. Does that make sense? Well, not does it make sense? Does that, do you understand?
Yeah. Professor, it's a very interesting point because, for example, in Argentina, we have adjustment for inflation, but it is different, the tax calculation from the accounting calculation. So if we are going to base on the financial statement, it's a completely different procedure to make the inflation adjustment.
That's so exactly right.
We make inconsistencies, a lot of inconsistencies. I agree.
And these rules are being developed largely by developed nations, the G20, that does not have these type of inflation adjustments or these kinds of questions. So these are significant issues, I think, for the region.
Professor, what will happen with dividends? How is going to be taxed the dividends that are received by the entity in the local country? How's the equity methods going to apply, or how we're going to deal with that?
Yes. So what the OECD has said is that they should apply the rules with all subsidiaries in the country treated as one entity. So there's going to be a consolidated approach to determine whether or not there was a minimum tax in that country. So if a company has 3 subsidiaries or a parent in a country that's a holding company that owns subsidiaries, we will look to the income of the group on a group basis, even if there is no tax consolidation under the local legislation. So this is going to be another area where the financial statements and the income is not from one company. It will be an aggregation of multiple companies to determine what was the overall taxes paid by the group of companies in that country. How about that?
And Professor, I see, what about this complication when most of the countries in Latin America are following the international financial standards, so the IFRS. So there are a lot of provisions and estimations if we talk about financial statements that will be the base of the calculation. So this is another issue that is related about what you are talking now, right?
It is. And what is the provision for taxes that are, that go into the tax expense, whether it is current tax or deferred tax, gets to the question of temporary differences. But you've also made another point that there could be differences in tax treatment and financial statement treatment, and that's going to create a permanent difference that will impact whether or not a minimum tax was paid. So permanent differences will impact the rate. Some temporary differences will be allowed, and the OECD will give us more information about what temporary differences will be allowed to be claimed. Even though I didn't pay the tax this year, I pay it next year because of timing.
Okay, Professor, one point that I want to raise to you is the issue of the rate. Sorry for come back to the rate of 15%. As you have said in the beginning of the description of Pillar 2, this pillar is something that is voluntary and is not compulsory to countries to adopt it. But please see a scenario where we have a country like Mexico that now considers low tax jurisdiction, the payments that are taxed lower than 22.5% effective tax rate. Mexico, the formula in Mexico is when you are not reaching at least 75% of the tax that will be payable in Mexico, that is the 22.5 that I am referring to. Mexico now has, for example, certain rules in order to deny deductions when you are making payments to related parties that foreign related parties that are not subject to this 22.5%. So in this regard, if Mexico wants to join, wants to adopt these Pillar 2 provisions, my understanding is that you need to adapt the draft legislation that will be produced by the OECD first, and second, is there any possibility that that Mexico has to change the criteria of low tax in order to decrease this 22.5 until 15%, or what would be this scenario that Mexico
that is
face?
a great question. That is a great question. So what the OECD is expecting is that if the minimum tax is due in the other country, Mexico cannot complain if 15% was collected. They would not have a subject to tax rule or that would apply in that situation. They could only apply it if the minimum tax were not done. So the undertax payment rule would have to be turned off. Mexico would have to agree that they have a rule that says 22% is the minimum tax, but if this framework gets adopted, then it would go to 15. Now, that's why the US wants the minimum tax higher. Okay?
Yeah.
And if it goes to 15, then it takes some of the national sovereignty away from Mexico and others to adopt a higher than the minimum, which is the effort for why multinationals may want this. If there's going to be a minimum tax, we want to prevent countries from doing more than the minimum. Now,
excellent.
Now, what is not obvious in the literature, but what I want to get to is that if some of you are thinking, well, my country won't adopt an income inclusion rule. We're not going to tax foreign affiliates from my country. Maybe your country will, maybe they won't, okay? You still care about Pillar 2. And the reason is that the comment that was just made about Mexico is what all of these other countries will agree to do in terms of the under-tax payment rule. And I have an example to work through how the other countries are going to force the multinationals in a country that does not tax the income of foreign affiliates, how that is going to leave an opening for the other jurisdictions to tax them up to a minimum amount. So what I want you to see is there's some gamesmanship here, that if a country does not tax its multinationals, that means there's at a minimum 15% rate. That means other countries that are making payments to that other jurisdiction can. And I'll give you an example. But before I leave this, if the US taxes its multinationals at a 15% rate and all of its foreign affiliates at a 15% rate, then no other country like Mexico can tax. They've lost their sovereignty to do so because it's been subject to a minimum tax.
Yes, and this is something that, Professor, at the end, what the many countries have to take into consideration is exactly what you said, because the rules are designing in order that the headquarters, the country where the headquarters are located, and they want to apply the anticipated taxation in the low income tax, the taxation goes directly to those countries, and countries like LATAM, which we are not the owners or these big companies are not residents in our country, then there will be probably some specific the loss of tax collection if they adopt this kind of rules.
Do you see how selfish the developed nations are in this conversation?
Yes, definitely.
There is a point of view. It is amazing to me that many countries from Latin America have agreed to this framework because it gives all of the rights to the jurisdictions that are the headquarter jurisdictions. If those countries do tax at a 15% rate, everyone else has to not tax. That's amazing. It prevents the diversity of decisions by Mexico and others to attempt to keep a taxing rate if the resident jurisdiction taxes at a minimum rate. There was a hand. I didn't see. Was there another question?
No, it was for me by accident, Professor. Continue. Sorry.
Okay. So,
Professor, I'm wondering there how for example, the tax incentives will play with this 15% minimum tax, because in LATAM we have many tax incentives granted to, I don't know, to set up a service center or software industry that offer very low income tax rates. So now all what is not taxed in the country will be directly recognized at the level of the shareholder and taxed at the level of the shareholder. So my impression is that the countries will need to review and amend also their tax incentive regimes to get a benefit and not to lose attractiveness, because actually maybe replacing the reduction in the income tax rate with, for example, a reduction of other taxes or indirect taxes or social security, because actually any recognition of income tax at the level of shareholder will automatically lose the attractiveness of the tax incentive regime.
That's exactly right. So if I can get a reduction on VAT or social taxes or ICMS or P's and COFINS or some other tax regime other than income taxes, then I can benefit from those holidays. But if I get a tax holiday on income tax, you're exactly right. That's the intent.
Yeah, it's not that easy, Professor, because in general, these tax incentives provide for fiscal stability. So I don't know, it will be really challenging to amend all those tax incentive regimes.
Yes, or the maquiladora regime in Mexico. I mean, there are many other type of regimes that have been motivated to promote manufacturing or research and development in local countries. But all of those, if it causes the minimum tax or the tax of the group to go below a minimum amount, then it will be subject to this income inclusion rule. Okay, I wanted to work through a couple of examples because I think when you listen to a presentation, and we're now more than about an hour into a presentation, your mind can wander and you can say, I'm hearing these words, but I don't see some of the issues. I'd like to see an example. So I wanted to just move quickly to an example, and I've given you an example of a Brazilian multinational that has several subsidiaries. One of them is in the US, one of them is in Chile, one of them is in Mexico with a Uruguay company, and then finally I've got a Colombian subsidiary. So I want to look through this fact pattern just to give you a comparison of how the OECD and how the US are thinking about the minimum tax. Now, where I want to start is with the Colombian company to the far right. In this example, I have profits before tax of $1 million. And the company has borne an asset tax of 15%. In the US point of view, this entity has paid no income tax. It's failed to pay a minimum tax. It is unclear what the OECD will say about whether or not the asset tax is a 15% qualifying tax. If it is, then this company has paid a minimum tax. The US point of view is they have not. But it's an open question about what the inclusive framework will say. Now, in my next example, I have a Mexican company and a Uruguay company, and the profits that are paid in Mexico, I say, is subject to a tax of 10%, maybe because of the maquiladora, maybe some other permanent differences, I don't know, but a 10% tax. It's an income tax, but they didn't pay 15%. So the amount of the extra tax should be 15%. Now, the OECD is considering whether some concession should be given to the fact that some regular tax was paid. It was below the minimum, but I did pay some income tax. But the way the framework has been written is that if this company does not pay a minimum tax, then there is a 15% tax that should have been paid, and it triggers the other provisions. So the point of my middle example is to say that if I'm below the minimum, the way the inclusive framework as currently drafted suggests that there's a cliff. You fall off the cliff. You're just subject to 15%. That seems unfair. It seems that you should be given some credit for the fact that you've paid some tax, not the minimum, but some. That is not resolved at the moment. Now, in my example with Chile, I have a company that had 1 million of profit, but there was a tax loss carry forward. The OECD has stated they will give credit for a tax loss carry forward. If I really lost $1 million in Chile in a prior year and I'm carrying forward that loss, then in determining my net income, I determine it after the use of tax loss carry forwards. So I have no profit and I have not had profit subject to less than a 15% rate because I have no profit. The US rule and position now is to give no credit for tax loss carry forwards. That we would subject this to a minimum tax, argue that this company did not pay a minimum tax. So the US is not in agreement with the OECD on this situation. Now, why does it matter whether the US agrees or not? You're saying to yourself, as you should, the US is way over here in a company that earned no profit. It's not the top company. So who cares about the US? The US may think highly of itself, maybe better than it should of itself, but it's not the ultimate parent. The US proposed undertax payment rule is that any deductions that I've claimed, $1 million, to the extent that the income of the multinational group, 1 million, 2 million, 3 million, 4 million, to the extent that my profits of the group, and then here's the fifth, was low tax. 4 of the jurisdictions were low tax out of the 5 million, 4 million of the 5 million did not meet the minimum tax. We would deny a deduction for 4/5 of the salaries in the United States. But Professor Wells, this payment was not made to these entities. That's true. We are saying that if I earn in this group anywhere a low tax amount, I will deny a deduction to this person who never made a payment to anyone else in the group. That's the effect of the undertaxed payment rule. If there is any undertaxed income, then the deductions can be reduced to any entity that adopts the OECD undertaxed payment rule. So in the US, our proposal is that because the income of this company, this company, this company, this company, 4 million out of the 5. I had Brazil, the top level company, paying a more than the minimum tax, but I had every other affiliate not. I would deny deductions for 4/5 of the US onshore salaries to local employees. So this is a reverse controlled foreign corporation rule. It is a rule saying that I'm conditioning my onshore deductions by whether or not I get a deduction, by whether or not my offshore income of any other affiliate has been low taxed. Now, if that doesn't sound like a compliance complexity, then I don't know what does. That is a complicated thing. Now, I have in my diagram a royalty payment from the US to Ireland, and I've assumed that in Ireland that royalty payment is not subject to a 15% tax. I can deny entirely that payment, any deduction. So the payment of the income that itself is low taxed would be 100% disallowed as a deduction. But the payments to my employees would have a prorated disallowance. Now, that result is a terrible result. In my example, under the proposal in the US, a company that earned no profit in this example would pay $378,000 of tax. It would, in effect, the US would collect all the low taxed income and subject it to tax because the other jurisdictions didn't subject it to tax. Now, that thinking is why you should care greatly about whether or not the asset tax is a qualifying tax in your jurisdiction. You should care greatly about whether or not tax loss carry forwards are going to be allowed. You should care greatly about whether or not, even if I didn't pay the full minimum, do I get any credit at all for having paid some local tax? Because if the answer to all three of those is no, it has a huge impact for this entity over here. There's a huge impact for this entity over here. And
Professor, if you allow me, that's a very interesting example, but I was just wondering, would the outcome be different had the Brazilian company, the top holding company, adopted the globe regime, regardless of what happens for the sister companies in Chile, Mexico?
That's a great question. That's a great question. So if Brazil had adopted the globe, now the question is, and the globe says you can use tax loss carry forwards, and the globe says you can use asset taxes, then yes, it will prevent the US from applying a regime where the minimum tax compliant with the globe has been enacted. So that motivates Brazil to adopt the globe. It motivates them, otherwise because doing so stops the US opportunity. But what about not paying the minimum tax, but almost? Well, if Brazil subjects this to an incremental payment and the globe says that's all that's required, then the US rule is turned off. So the effect of the US rule can be seen as motivating other countries to adopt the globe. I can say it otherwise. If other countries adopt a globe like we do, and we tax the headquarters, then it prevents the US from adopting an under-tax payment rule. But if this country does not adopt an income inclusion rule, God help you. Because the US won't. Neither will Germany. It's going to be, so this is the point that I want to make sure people from Latin America understand. You may be right that your jurisdiction may not want to adopt the globe. They don't have to. But if they don't, then you're going to be very concerned about your affiliates that are in a developed nation and the impacts of earning income around the region and whether it can be viewed as low taxed. Do you see how you're going to have to be very conversational among the community? You cannot simply give advice all by yourself. Now, the US rule, our form of the globe, is much more abusive. Imagine that, that the US rule is not as nice as the globe. We would give no credit for asset taxes, and we would subject the ultimate company under the Biden proposal at a 28% rate. We would give credit for these taxes, so there we are nice. And here, if I have a tax loss carry forward, I would give no credit to the tax loss carry forward and subject the profits to the full US tax. So the US approach will be to have an income inclusion rule that is above the minimum and will not give concessions, at least for now. This is subject to further discussion in the Congress for tax loss carry forwards and other relief. So let me give some final thoughts and then we'll have some question and answers. Who are the winners? Market jurisdictions. If there's a country that is getting products sold into the country by companies that do not have a permanent establishment, they now have a taxing right to tax on a formulary basis the digital income, the internet income earned outside of the country by that company. Territorial regimes are not required to adopt a globe. They do not have to change their tax situation. Now, the benefits of companies that are in a territorial regime are greatly reduced, but they do not give up their prerogative to not tax in their country if they don't want to. Mid-sized multinationals, for now, are excluded from the conversation of Pillar 1. They are a partial winner, but the OECD has said that after 5 to 7 years, they will reduce the threshold to capture more of these companies in Pillar 1. Partial winners are the largest multinationals. Yes, they will be subject to tax on a digital tax in countries, but only 20 to 30% of their residual profits, not all of it. And countries that want to tax them as remote sellers into their jurisdiction are required to comply with a uniform framework. So the largest multinationals have some benefits and some detriments are prevented. If the US collects a minimum tax of 15%, that stops Mexico from using an undertax payment rule. Residency jurisdiction gets the first right. If you're headquartered in Germany and they subject the profits to German tax, then you cannot subject the related party payments to a disallowance. You cannot condition the withholding tax concession on a higher rate. So I think developing nations that do not have headquarter multinational enterprises have not won in this debate. I think they've lost in this debate. So I think we are going to a new world where tax advisors and global companies are going to need to think through not just the existing permanent establishment transfer pricing rules and physical presence tests, but they're going to need to think about how these market-based taxes will apply and whether or not. Those are my prepared remarks. Any questions from the audience or anyone else?
Professor, thank you very much for the presentation. It's amazing to talk about the new world, as you mentioned. It's not only for tax advisors like us, it's for our clients, something quite important to understand what is coming and what is coming very quickly. I think that this is something that is happening. There is not too much analysis or information regarding these issues, and it's something that is right there. So basically, we really appreciate your your thoughts or your presentation, because this is something strategic for us and for our clients. I think that we have more than 100 people listening after 1 hour. So I think that the content that that you provided is quite helpful for everybody. Just as a conclusion, and maybe with this we can end the presentation, is just, if you can, after having analyzed all of this topic, can you put some, let's say, list of which are the topics or the traditional elements of international taxation, like, as you say, permanent establishment, transfer pricing, which will be affected or will be changed, switch, or whatever is going to be impacted by this new war and new reality in taxes, which is maybe in separation to the two pillars, but which are the most important focus that us as advisor and our clients need to bear in mind very soon?
Yeah, so what I would say, I think you focused on permanent establishment, transfer pricing, this digital tax, and the foreign tax credit that will need to be given, the minimum tax and how we're going to compute that from financial statements and local. I think what I draw from this is that tax professionals now need to be much more global citizens. You're going to have to know what your colleagues in other countries, their tax planning, what are the results of those operations, how the rules interact with each other in a way that means you cannot be an isolated person. You're going to have to be part of a team, and you're going to have to work with advisors and business leaders in global companies that are now understanding that the world is going to think about them as a collective, and their advisors need to start thinking that way too. So what I would say is one of the most challenging areas is that when I cannot say whether I get a deduction or what the withholding rate is until I know what happens in the other jurisdiction, maybe the other jurisdiction that I had no payments to, then that opens your mind to see that when I'm advising a multinational, I'm going to need to know a lot about their story in order to advise any part of their story. To me, that's the big challenge of these rules. It's easy enough to say, just pay a minimum tax. But how do we determine that, and whether or not a minimum tax was paid anywhere in the multinational, and the implications that has for countries that have an underpayment rule in place that the OECD will adopt, is going to require a level of conversation among practitioners. For firms like KPMG, it's going to be fantastic. But for your clients, they're going to require firms like KPMG, because it's going to be very difficult for a local advisor who doesn't see the rest of the world to be able to manage global clients.
Professor, I have some questions, because probably at least Colombia is going to focus a lot on the subject to tax rule, and rather than pillar one. Right, we're going to focus a lot in subject to tax rules. And I would like to understand and probably provide to the audience, if one of the methods to be applied, and if you can explain the alternatives that exist currently and being discussed, the refund process is one of them. Let me explain a little bit. There's a trend in our country that provide treaty rights. The tax authorities would like to give it through apply the maximum rate and then apply a refund process. Is that according to what I have read, that's potentially a possibility. What is being seen in subject to tax rule? What has been discussed around that?
So that is a great question. So I want to give you this hypothetical. Suppose that Colombia adopts a subject to tax rule and an under tax payment rule, like I just said, and so does the US. They're competing for the same under tax payment, right? So we have a company that does not pay residency taxation under a globe, but we have two jurisdictions fighting for the under tax payment rule. What the OECD has said is that under tax payment should be shared among Colombia and the United States on a proportion to revenue basis. Now, getting the US and Colombia to agree on what is the proportion of their right to tax the underpayment that belongs to Colombia and the portion of the underpayment that belongs for the group to the United States is complicated. Now let's say there are 10 countries that all want to tax the underpayment. Now we need to share among 10, not 2. That just got more complicated. So Colombia may well have the right in the first instance to tax the under tax payment rule or the subject to tax rule. But if multiple jurisdictions assert the same right, there will need to be a mutual agreement procedure, and that's what the OECD has said, for the countries to agree to how to prorate that among the different jurisdictions. How about that?
Professor, thank you for your comments. We have 2 questions made by the public that perhaps you could clarify, even though you already made the remark. There are 2 here. One is Jessica said she would like to know under Pillar 1 what a country requires to obtain a percentage of earning taxed within the range that is allowed to be attributed with. Will this require a minimum amount of earning by the foreign entity in the relevant country? That is the question.
Yeah. Okay. So let's go back to the slide that I had for that. And the nexus requirement I have under 2 is that you need to generate 1 million of revenue in the country to be subject to this rule. But if a country has GDP, gross domestic product, of below 40 billion euros for the country, then that threshold becomes 250,000 euros. So what the OECD expects is that countries that are small countries, small economies, can get a lower revenue threshold, but countries that have more than 40 billion euros of GDP, they can only assert this market taxation right if the multinational earns 1 million in revenue, not 1 million of profits, but 1 million in revenue from the jurisdiction.
Excellent. And there is another one that's, could you please repeat the date? So now people are concerned about where this will be in place. Could you please repeat the days where the Pillar 1 and 2 could be applicable, and which is the process expected to happen from OECD guidelines, frameworks, until local regulations are modified?
Yeah. So October of this year is a huge date, not just because my birthday is in October, but because that is the date when we are going to get a broad technical pronouncement of how Pillar 1 and Pillar 2 should be implemented, and the changes to the treaties with model treaty language that countries should use to modify the permanent establishment provisions and the transfer pricing provisions to accommodate these changes and the mutual agreement procedures. Those publications will come out, the OECD has said, in October. At that time, there will be an agreement of what the minimum tax is. The US is lobbying hard to have the rate higher than 15. There are other countries that are lobbying to have 12.5, the Ireland rate as the minimum rate. But in October, there will be a more detailed framework. In 2022, countries will take the draft legislation that the OECD will give them and will take the changes to the treaty provisions that the OECD will draft, and the legislatures of the jurisdictions that have agreed to implement will adopt those changes in 2022 with an effective date for these changes to go in place starting the beginning of January 2023. Now, do I believe that timeline? I don't know, okay? I mean, but what I'm telling you is that unlike the normal legislative process, the legislatures are going to be given the documents that should be adopted. So many on this call will know about the multilateral instrument that the OECD implemented several years ago, and a lot of countries have adopted the MLI agreements. And what the OECD expects is that countries will simply adopt this legislation, and they must repeal all digital taxes in 2022 that are not compliant with the OECD framework. Any country that has an undertax payment rule that is non-compliant with the framework must modify their legislation during 2022. So the United States has non-compliant tax provisions. And if those on this call have kept up with the United States politics, you can only imagine how difficult it would be believe that how the US is going to adopt these changes. But the OECD expects that the US and every other country will conform their legislation by the end of next year. How about that?
Thank you. I don't know if one of the panelists have some additional remarks before we conclude, because after the panel, we will pass a survey. And please, the people that are still here, please help us with their feedback.
Yeah, so my only last comment is, do you see my steamroller here that's just plowing, crushing all problems and just running over the problem? You see that on the slide? That's the picture. So let me open it up. Other panelists, any other comments?
I think that we are done, Professor. So thank you again for this huge presentation, and maybe we will have another opportunity in October or November, expecting the what is gonna be proposed by the OECD. Maybe it's gonna be a good opportunity to have a more detailed conversation about what is being proposed. So for our clients and people in the audience, be aware about that. Maybe we can do something again. So thank you very much. And if anybody else is having another question, I think that we can conclude. And again, thank you for this presentation, Professor. We will be in touch for sure.
Awesome. All right. Well, thank you. It's been wonderful to see all my friends at KPMG, and hope this was helpful to everyone that participated. Take care.
Thank you.
Thank
Bye-bye.
you, Professor. Bye-bye.